My name is Jim Bromley. I'm the co-head of the firm's global restructuring practice, and I'm joined today by my partners, Ari Blout, Neil McKnight, Inosi Nanyata, Andy Diederich, and Chris Howard. So let's kick it off. We're going to talk first with Neil and Ari, who are co-heads of the finance practice here at S&C. Now, in the last few weeks, we've had a lot of turbulence in the markets for a number of reasons, obviously relating to COVID-19 and to the slump in oil prices and the Saudi-Russian issues that we've been facing. A lot of companies are in the market looking for additional financing, drawing down revolvers. Can you guys tell us what you're seeing? What are you dealing with on a daily basis?
So, I think we're seeing a lot of different things in the market right now, and it really depends on two things. I think the first is the status of the issuer or borrower prior to COVID-19, and then the second is, their credit rating. Investment grade borrowers and issuers have had fairly decent access to the debt capital markets, and we've seen a significant number of investment grade issuers access the bond market recently. The other thing we've seen investment grade companies doing is a number of them have entered into 364-day facilities. And the reason for that is that the banks right now are pushing for, one, it results in a lower capital commitment, but it creates less durational risk. This is different than where investment grade companies have had more difficulty in getting new revolver commitments that are long dated, such as, increasing the size of a 5-year revolver or a 3-year revolver. That's been where the investment grade market is pretty focused. Neil, do you want to give an update on the sub-investment grade market?
Yeah, the sub-investment grade market has been a different story. It's been really a risk-off approach, and so investors have had a lot more difficulty. Companies have a lot more difficulty in the sub-investment grade market. A lot of that had to go with secondary market. The secondary market traded very wide, and that affected the primary market. And so really we have not seen a whole lot of new issuance in the sub-investment grade market. I think the real exception to that is in the past couple of weeks, we've seen people come back and do new 5-year non-call 2 secured notes issuances. And so we've seen a fair amount of those.
And the one thing to note is, the government provided stabilization to the IG bond market through secondary buying. So that's helped that sector, those issuances be stabilized much quicker. Whereas, the loan market and the sub-investment grade bond market doesn't have a stabilizing government influence. But there's actually starting to become a pipeline of particularly bond rather than loan deals coming to market over the next 2 weeks. So it'll be a good test to see how that market continues to hold up.
And Jim, I think the tenor of the market is definitely a more hopeful tenor than it was a few weeks ago. I mean, if you think about the pattern of the crisis, when the crisis first hit, there was a lot of uncertainty about what things were going to happen, what was going to happen. I mean, as Ari said, the investment grade market stayed very resilient. That's exactly what we saw in the 2008 financial crisis. And really the same repeat of what happened in 2008, where spreads went wider in the investment grade space, but the treasury rates were very low, so the all-in coupons were reasonable or even some ways attractive for people. But the non-investment grade market basically shut down for a little while, and that's really changed as the market generally has stabilized, and you've seen equity markets come back. And so I think as we look forward and talk to companies about what's coming, there's so much uncertainty, of course, in terms of the pace of the pandemic and what the effects are going to be and so forth. But we're at a better spot in the market in terms of people being able to access new credit than we have been certainly over most of the past months.
And so that stabilization has come over the past week or so?
Yeah, we've seen it come, particularly over the last week. There's been a couple kind of headline sub-investment grade deals that went to market for more troubled companies like Land Areas, as well as Golden Nugget. And both of those deals were heavily oversubscribed. Every was in the market this week, another company with another very heavily oversubscribed term loan. The rates on these deals have been upwards beyond 10%. So whether or not it's because there's been just a few issuances or the particular rates and coupons being offered that are attracting investors, I think people will have a much better sense over the next 2 weeks where particularly the term loan B market is and the sub-investment grade bond market, because a lot of companies and portfolio companies and private equity funds are planning to kind of go to market in the next 2 weeks, and that should be a good test on where the market is right now. We're drawing some inferences, the best we can, from the limited number of new deals that have come to market this week and in the end of last week. I think Neil may have frozen.
In the immediate term, and it's very difficult to give predictions much beyond the next week. We'll see on the investment grade side as we go into other companies are going to go into their blackout. So I think you'll see less volume on investment grade over the next couple of weeks, and then hopefully once we get through earnings, a more stable issuance market for investment grade. Non-investment grade will face a similar effect, I think, as we go into earnings, and it'll be interesting to see whether the bank market picks up in this period where not as many people are accessing the bond market.
So you focus on oil and gas. Can you tell us, obviously there's a lot going on. What are you seeing? So you're on mute.
Thank you, Jim. The oil and gas space has obviously been right in the middle of both COVID-19 and the significant dip in oil prices, particularly after the Saudi and Russian issues emerged. And so they've been sort of caught in the whirlwind of both. So we are seeing some of the same issues as Ari and Neil mentioned, particularly between investment grade and sub-investment grade. But in addition to that, there's sort of buckets that are facing slightly different issues. In the upstream exploration production space, companies there are significantly hit by the oil price issues. Many of them were already in situations where there were liquidity constraints and concerns about reducing oil prices, and the dip because of the Russian and Saudi issues just made that worse. A number of them in that space, I think, will be the category of company that we'll be hearing about when we have the restructuring piece of this discussion later in the session. And so they are sort of really in distress and looking at restructuring. Those who are looking for additional liquidity and are facing some of the same issues that Ari and Neil mentioned. If they already had issues before, there's much less funding available to them, but there are attempts to try and bridge the current situation, if possible, to hopefully a stabilization of oil prices to the extent that comes. I think there's a lot more optimism this week than there was a couple weeks ago that prices will stabilize, although as you'll see from day to day that varies. In the integrated oil and gas space, particularly the investment grade bigger companies, we've seen a 364-day facilities, a number of companies going out to get term loans, and so shoring up liquidity has been a key focus over the last few weeks. There's also been a lot of companies in that space who have taken steps to reduce their capex budgets over the next period. And so there's sort of a significant reduction, which means final investment decisions that were coming up in 2021, in some cases have been postponed and are being pushed to a later date. That could potentially have a beneficial impact for projects that are able to go ahead at a later date. That could mean lower capex costs as contractors sort of look for those opportunities and are willing to then reduce capex costs that were getting towards the higher end at the beginning of this year. So sort of there's a varied approach there, and companies in the infrastructure space really are sort of focused on their counterparties who are facing some of the same issues Ari and Neil mentioned, or are themselves, E&P companies. And so there's a very big focus on looking at counterparty risk. Can counterparties perform? Are they affected by FM? And how that then flows through the ongoing cash flows of the companies that are in it providing infrastructure and other sort of midstream, downstream support.
And Jim, it's interesting. The oil price stabilizing hasn't been covered as much, but that's been a significant factor into it's particularly the non-investment grade market stabilizing some. If you think about it, the market was really hit with a double whammy between the pandemic and the oil price shock. Participants in the oil and gas sector are a significant part of some of the non-investment grade indices. And so when you had both things hitting at one time, that really created a lot of downward pressure and selling pressure. And so the fact that you've had the prices stabilize some, I think has been important in that. That's another sort of risk in the market, because to the extent there's more turmoil there, even if the news improves or things stabilize on the pandemic front, we could have a longer term effect as a result of what's going on in the oil patch.
So in addition to the capital markets and the loan markets, what other alternatives are there for those liquidity constrained borrowers that are out there?
Yeah, there's really two big buckets right now. The first, we'll call the government programs. And the government programs, I think, are the things that most borrowers and issuers are most focused on trying to understand outside of the debt capital markets and the loan markets. So the first one is the SBA Paycheck Protection Program. And I think most people are fairly familiar with that. That's a forgivable loan up to $10 million from the SBA. It's the lesser of 2.5 months payroll and $10 million. And there's a lot of kind of parts of this program where, if you're a restaurant or a hotel, you can look on the by property basis. So I'm not going to spend a lot of time on this, but this is really something that's been significantly helpful for small businesses, or to the extent a company is able to qualify under some of the exemptions for being able to get under 500 employees, whether it's by restaurant or hotel. It's providing some short-term liquidity relief, but it's in no way kind of a long-term solution for companies. It's a bit of a Band-Aid to get people through a couple months. The one that I think a lot of our clients are focused on is what's being called the Main Street Lending Program, which is going to be by the Federal Reserve. And that's for companies with over 500 employees and less than 10,000 employees. Now, I think there's a lot going on with Main Street right now. Treasury put out, and the Fed put out their press release. But I think it's more of a work in progress, to be honest, from our discussions, than I think people understand right now. And the final form that Main Street may take may be fairly different than what's being discussed, hopefully. One of the things to kind of keep in mind, or two of the big things of maybe 20 or 30 things that may or may not change with respect to Main Street, are one, the leverage requirement, and whether or not that's going to be finalized at 6 times, because that would exclude a lot of companies and would be particularly problematic for companies like tech companies where EBITDA metrics are not the appropriate measure. The second thing is, where does the Fed and people come out on whether or not Main Street is going to be subjected to the Shared National Credit Review? And that's going to be really important for borrowers and issuers. And the reason for that is that one of the big changes under the CARES Act was that if you were not a troubled borrower prior to, the COVID crisis, it gave the banks the flexibility to amend your loan without it being deemed a troubled loan because of those amendments. And Main Street, if it's included in the Shared National Credit Review, where the regulators can say, hey, bank, that's a bad loan for regulatory capital purposes or for your regulatory review, it's going to have a lot of, downward pressure on the ability of banks to make these loans. So those are kind of two things to watch. The other kind of big bucket, and I'm not going to go through all the government programs because there's a lot of them, and a lot of people are considering them, and what are the strings going to be, whether it's no dividends, limits on exec comp. I think all of that's trying to be figured out. The second big bucket are PIPE transactions, private investment in public equity. And there's a significant amount of capital out there right now looking to do PIPE transactions. That said, there hasn't been a significant pickup in PIPE transactions as a result of COVID. I think we expect that to really get going end of April, beginning of May. And the two reasons that you're not seeing issuers or borrowers going to the PIPE market are three, to be honest, is first, they want to see where the government programs shake out and what type of money and support they can get from the government and the strings attached. The second is trying to figure out equity prices. You know, what are your equity price in a PIPE? Is if it's a convertible bond or you're getting a warrant or it's a straight equity investment, what's the appropriate equity size, the equity dollar number? And I think the third reason you're not seeing PIPE transactions picking up yet is where we started out is people are trying to figure out, most importantly, where are the debt capital markets and where are the bank debt markets and what can they access there versus in the PIPE market where it could be significantly dilutive to equity or, you know, the economy recovers very quickly. You could have given away a large chunk of the company at a discounted equity value.
So, and Jim, if you're thinking, going back to the government programs, just stepping back and thinking about the big picture, you really have, in response to this crisis, the government and the Fed in particular interacting with the private sector in a very different way from how it has done before and how it did in 2008. I mean, in 2008, a lot of the support and a lot of the crisis was focused on the financial institutions, and support was targeted to financial institutions plus some other industries. Here, the broad, the effect has been very broad, very correlated, just correlated in terms of affecting everybody across the country. And so the Fed, through programs like Main Street, is trying to interact directly with corporate borrowers in a way that it just never has done before. And so I think the challenges and the practical challenges of trying to operationalize a program like that are going to take longer than people would hope for. And it's a matter of fact of rolling out a program of that size, figuring out how the banks are going to originate, how the Fed participates in the loans that the banks originate, what the criteria are, how it fits within existing capital structures, and so forth. So I think there's a lot of will there to try to support companies, but a lot of practical difficulties to actually deliver the funding.
And one of the big things to note that's fairly different between Paycheck Protection and Main Street lending that people, I think, in the corporate market aren't focused on enough is Paycheck Protection. The banks are really just conduits, right? Those are effectively fully guaranteed loans that the banks are making by the government. So the banks aren't really taking credit risk with Paycheck Protection. They're required to kind of make sure they're doing the underwriting, but at the end of the day, the government's guaranteeing Paycheck Protection. That's fairly different from Main Street lending, where the banks are going to be making real credit decisions. So it's not like Paycheck Protection, where if you're a small business or you otherwise qualify and you check the box, the banks is just going to give you the money.
So let's talk a little bit about covenants. I have to say, over the past several weeks, I've been on a ton of phone calls about the impact that the crisis has had on the metrics of businesses, right? And so a lot of borrowers are worried about their covenants. What are you guys seeing in OC, Neil, Ari, in connection with waivers and amendments? What are people looking for? What kind of covenants are at issue? And almost more importantly, what are the lenders doing? How are they reacting to these issues?
Well, financial covenants are definitely top of the list for people in terms of things that need to be amended. And the real concerns, I think, are kicking in with the second quarter with financial covenants. And just to make sure everybody's on the same page, when I refer to financial covenant, what I mean is a covenant where a business agrees to maintain a specific financial metric within some parameters. So, for example, a ratio of debt to EBITDA or an interest coverage ratio would be a financial covenant. And usually those covenants are tested at the end of financial quarters. And they're tested on the basis of the past year, so an LTM basis. So it's the year to the quarter that's ended. So if somebody has agreed with their lenders that they're going to maintain a maximum leverage ratio, and that's tested in each quarter, most people were okay for the first quarter because most of the year had already passed before the pandemic really hit, at least in the United States. And so their operations are not affected. But as you look forward to the second quarter, a lot of people, you have a full quarter of the effects of the pandemic. A lot of people are expecting that there are going to be issues with meeting those financial covenants. So what does that mean, and how do you deal with it? There have been a number of different requests. Typically, if a company was having issues with a financial covenant, they would update a financial model, talk to their banks, and then they would reset the covenants associated with it. The problem is, who knows what's going to is this going to be a 1 quarter, 2 quarter, 3 quarter effect? How will it affect businesses? People don't really know. So modeling is different, is a lot more difficult in this situation. We're seeing to responding, asking for a reset of covenants. More commonly, people asking for a complete covenant, sometimes longer, or a covenant holiday, and then covenants resuming, but at higher levels. And then with step downs to take into account that even if you're in the first quarter of 2021 or second quarter of 2022, there'll be a lag effect because you'll be including quarters from 2020 which were affected by the pandemic. People are looking a lot also at how EBITDA will be calculated, how they're going to, what add backs might be available to EBITDA to take into account the cost or lost revenue. Usually it's more easy under different definitions to add back cost associated, or one non-recurring and one-time cost associated with the pandemic to EBITDA than it is to try to add revenue that you lost or you would have earned. So there's issues, and also, if a business is really shut down, the add backs are not going to be sufficient in any event to fix a financial covenant issue. People are also thinking about once the covenant restarts, how am I going to calculate it and deal with the LTM issue? And there are different approaches, but one of the approaches that people are thinking about is to annualize EBITDA once you resume. So if you're going to look at a covenant for the first quarter of 2021, for example, you take the first quarter results for 2021 and just annualize them over a full year, or you take the past 6 months and annualize those over a full year. So there are different approaches. And also, frankly, I've seen some companies who look at it and say, I don't know for sure. I know that I'm going to need relief through 2020. I'm going to get a holiday through 2020. And then I can go back and sit and talk with my banks later in the year, depending on how things play out, because it's just too hard to try to negotiate a framework for 2021 right now. Ari, do you want to talk about some of the things that the banks are asking in connection with financial covenant amendments?
Yeah, the lenders have been, I've been dealing with lots. Pretty much financial covenants is about 12 hours a day worth of phone calls every day these days. Lenders have been generally cooperative. I put companies into 2 buckets. The first bucket are companies that were troubled prior to the crisis. So COVID was piling on, and I think those companies have had more difficulties with their lenders. Companies that were either relatively healthy or healthy prior to the crisis that are having real significant issues now have had a much better go with their lenders. And we've seen that in hospitality, entertainment, sports, retail. For non-troubled retailers, that's not a big bucket. Lenders have generally, in the syndicated market, been looking for consent fees and in some cases interest rate step-ups. We've seen some push for anti-cash hoarding, which effectively says, hey, you can't have more than X amount of cash in your balance sheet. But we've seen borrowers effectively push back on that. The one thing that I think has been pretty ubiquitous in connection with the covenant relief is that there's a big cutback on the ability of borrowers to take certain actions. Particularly lenders are saying, look, if we're going to give you a covenant holiday for a year, no dividends, no stock buybacks. And sometimes the lenders have been pushing for other maintenance covenants like minimum liquidity. I'd say the lenders as a whole, and look, this is very different. We have companies who are very distressed, who are having a very tough time with their lenders. But I think 80% of the companies out there right now have been able to get pretty constructive and long-lasting financial covenant relief that is going to help them at least through 2020. That's not always the case, but it is something that we're seeing. The two things I just note that are kind of different right now are historically, when you were seeking financial covenant relief or you're seeking an amendment, your revolving banks were kind of, okay, the revolving banks are going to give us the amendment, and now we're going to have to deal with our term loan A or term loan B lenders, depending where you are in the capital structure. I think this time, generally, again, it's different by every borrower or issuer. The revolving banks have been more difficult or demanding more as part of the covenant relief and covenant cutback than the term loan lenders. And I think part of that is the revolving lenders have saw a significant amount of drawdowns of their revolvers recently across the board. So they have a lot more liquidity actually exposed right now than historically. And it also has been putting more pressure on kind of regulatory capital. So it's a little bit of a different playbook right now versus who's going to be more helpful and who's not. I don't know, Inosi, what are you seeing in oil and gas and projects?
I think the point you made about borrowers who had problems before versus borrowers who only have a problem now is very significant in this space. If it's an issue that really is kind of mostly COVID driven, then there's a lot more flexibility to deal with bridging the gap to go back to normal, whatever normal will look like, and more flexibility by lenders to consider that. But if there are broader underlying issues, there's a lot more reluctance. And one of the features that in the oil and gas space that we are facing now is on construction loans, on development that's continuing. The need to be able to continue to construct, assuming your supply chain is still working and your contractors are still able to come onto the site. Because if that stops and the spigot on drawdown stops on construction, that can have much longer impact on construction delays, on being able to get renewable energy credits. There's sort of a knock-on effect on that, and so being able to continue to draw in these circumstances is a key focus for construction on construction loans and developers. And so the factors there include looking at whether this is just FM that you can get relief on, or whether there are broader issues that impact the ability for the project to proceed and get to construction on time. MAE is another big focus. I think half of the day is financial covenants, the other half of the day is MAE, and how that plays out. And some of the difficulty there has been, how long do we think this will last, right? Which is a big open question, both for COVID and for the oil and gas issues, and being able to sort of make a judgment about whether a particular impact today will be significant enough that it will have MAE is a very difficult discussion and a judgment call in many cases, but that is critical in many cases for being able to draw down on the loan to continue construction to get to when you will have revenues. So these issues are playing out, I think, in all of these spaces in slightly different ways. And as things stabilize and people have a better understanding of the overall picture, hopefully, it gets easier to make some of these determinations, especially those that relate to the time element, which has been very uncertain and is still uncertain in many respects.
So how do you guys see the long-term impact here in terms of financing coming out of this crisis? Any particular observations on how it plays out over the longer term?
I think that's the million-dollar question. A lot of companies are trying to, they need liquidity, they want to get liquidity, but how COVID plays out is the big question. They don't want to give away the house right now if you're a healthy company, or do a pipe deal where you completely undervalue your equity. And a large part of it is, when does the economy reopen, and what is it going to look like it's going to reopen? So for instance, a lot of our clients, if people right? If people go back to work in, let's say, June, but it's just a different world for a year and a half where people are uncomfortable getting on airplanes, going to sporting events, going into movie theaters, it changes how you think about your financing and debt capital structure and whether you're willing to do a significant pipe, whether you're willing to take government programs that may limit dividends or stock buybacks. If you think in 6 to 9 months from now, the country's completely back to normal, people are showing up at theme parks, going to restaurants again, it changes your view. And I think that's one of the big struggles. I don't know, Neil and Osi, kind of your thoughts.
Yeah, no, I agree, and I mean it's still I fear early days yet to be making a lot of predictions because we have to see. I mean, it could be a relatively short effect, or we could. I mean, go back to those government programs like Main Street lending. We could come out of the crisis with the government being a participant in the capital structure for a large number of private businesses in the U.S. That would be a really significant change to how businesses are financing themselves and the role of the government in the economy. So how these things play out, what the long-term effect is going to be, it is hard to say. I do think, in particular in two sectors, the effects that we've seen here, I suspect will cause the banks and companies to reassess the instruments going forward. Revolving credit facilities is the first of those. Between revolvers, if you're in the business, revolvers were always for lenders generally the sour that went with the sweet, meaning the sweet was the fee-based transactions like underwriting bond issuances or placing term loans. The revolver is what you had to hold as part of the price to do that. I don't think that revolvers were priced in a way that expected them to be drawn fully in the way that most people or many people have in the crisis. So I think to the extent the revolvers were sour before, they'll become more sour and going forward, and those commitments tougher to obtain or maybe repriced. The other thing I think going forward is receivables financings. Receivables financings have always been based on portfolio theory that, if a company may have an issue with one or two customers in terms of those receivables not being good, but because you sold to a lot of different people, your receivables financings were secured financing by receivables facilities were priced with very favorable financing. I think now you're seeing widely correlated effects among companies who have receivables from, for example, retailers, where you could have a lot of those receivables not be good or go slow pay at the same time. And so I think that could have a long-term effect on the receivables market.
Yeah, the only thing I'd add is also this element of this potentially being a recurring issue, right? If we have to deal with COVID or COVID-like situations, maybe every year, maybe every couple of years, then how do we think about that in terms of providing flexibility for operations? For projects and special purpose vehicles, one of the things that we realize as we look through the papers is that they generally don't provide a lot of flexibility for working capital because it's very structured. You're depending on a cash flow stream, and you don't have kind of baskets for other unsecured debt that you might need on the short term as much as you might with an operating business. And so will we start to rethink providing some broader baskets for that? I think there will be more focus on force majeure and the scope of force majeure and how it impacts various provisions in debt documents and also keenly in counterparty agreements with lenders, everyone focusing on those provisions a lot more than they might have in the past. The other piece I think we're seeing some questions on and may escalate and become a bigger focus is insurance, business interruption insurance. Is that something that should be thought about in the ordinary course now, because we might be having situations like this that recur? And a bigger question, will the insurance industry take that risk? So I think it's sort of a space to watch, and how long this lasts and how long it might last in the future and whether it recurs are going to be key questions.
Yeah, and Jim, whether you see real changes or not, depends on your view. You know, the last major flu pandemic was 112 years ago. So, and you know, before that, it was 100 years before that. So it's really a question of, do you think this is a once every 100, 150 year event or not?
Good point. Good points. Thanks very much. Let's shift gears a little bit to the restructuring side. And I'd like to turn to Andy Dieterich, who is together with me the co-heads of the global restructuring practice here at S&P. So Andy, we've been in a lot of board meetings over the past couple of weeks. And seems like they're never ending. What are the main topics that boards are dealing with at the moment? The strategies that they're considering and the fears that they're facing.
Yeah, Jim. So, as you know, as well as I do, we've been giving a lot of fiduciary duty talks to boards. To a lot of boards that didn't think they ever would have to hear the insolvency fiduciary duty talk. And that's always an interesting conversation with directors, because the 8 or 9 years, 10 years since the last financial crisis, or the end of the last financial crisis, has seen a lot of innovation in Delaware law about director duties and insolvency. And we still see, as we come into these situations, a lot of misunderstandings, right? We see those letters from creditors that say you owe a fiduciary duty to your creditors. And we see directors and others who worry about being in the zone of insolvency, the quote zone of insolvency, and what, how their duties change in that respect. And as you know, the most important thing to remember for a Delaware corporation that is in financial distress is there are no new fiduciary duties at all. That the same fiduciary duties that have always applied to the company continue to apply. The duty of care, the duty of loyalty, the duty of good faith. And that's sometimes surprising advice, because people freeze up and they think, we're in this situation, we can't take risk anymore. We need to shut down. It's very important to be able to put a board of directors in a position where they can't take risk, the same risk they could always take it. You had a nice phrase once when we were on the phone the other day that I remember, where the basic premise of Delaware corporate law is that the board of directors can swing for the fences. And you can still swing for the fences even in this zone of insolvency, as long as you do so carefully. So we like to talk not so much about a zone of insolvency as kind of building a zone of safety, so the board can take the risks that are actually necessary to take to save a business. Because a company that is frozen up is not a company that's going to be able to stay out of Chapter 11, ironically. Of course, there are important differences in the zone of when you're near insolvency for the fiduciary duties. They're not in the substance of the duties themselves, but they're in two questions about how they get enforced. So under Delaware law, if a corporation is actually balance sheet insolvent, then the creditors can bring a derivative action instead of the stockholders. The same derivative action, the same standard, duties to the enterprise, but the creditors can bring the action rather than stockholders. And the second thing, of course, is that if Chapter 11 ever happens, the fiduciary duty action belongs to the corporation. And that could be brought by creditors, could be brought by the estate, could end up someday in a litigation trust against the directors. And so it's very important to follow the same best practices that we do for corporate governance for solvent companies and insolvency, just to make sure that we build the best defense. But we start with fiduciary duties, as always. But the message, and this is the most important thing, the message is you can indeed take risk as long as you are thinking about the downside and have a safety net or a contingency plan that's also part of your corporate planning. Those safety nets and those contingency plans, we actually have a little slide in the deck, which is a version of something that we've used with a couple different companies. That's a Gantt chart on slide 14 that shows the kind of parallel planning that's necessary for a board in this circumstance. So there's discussions about how your business is reacting to COVID from a liquidity perspective, business planning discussions about how much liquidity you need and trying to do the impossible and predict your operating cash flow. Then there's discussions with your revolving lenders, your other sources of liquidity among your creditors, that then determine some kind of what we call a ready date, right? Or a date by which you may have to exercise some kind of court protection. Those discussions can keep extending that ready date again and again and again, but establishing that ready date is very important. And then once you have that ready date established, there's a contingency planning process that puts the company in a position where if it needs to, it can then use Chapter 11. But no company ever makes a decision to file for Chapter 11 until the very last moment. So the parallel processing of this exercise is very important. But the upshot for a board is your duties are the same. They go to the enterprise, perhaps not to stockholders, but they're the same duties. You can really take risk. You can make judgments about equity versus debt, versus liquidity, as you think in good faith is in the best interest of the company, as long as you have some kind of a safety net for the worst case scenario when you run out of money.
Yeah, I often find that what you're dealing with almost more than the finances is the psychology of the company and the management and the board, accepting that there's issues, right? It's like the 5 stages of grief. The first is denial. And so when the restructuring lawyers walk in the room at first, the initial reaction is leave the room. And we don't want to talk about it. And you've got to go through bargaining and until you get to acceptance, right? I think it's important that we bring the boards to that point where they recognize that having contingency planning isn't a bad thing. Indeed, it's a critical thing, and it provides you with more optionality. Andy, now you had the pleasure of filing a very large Chapter 11 yesterday in the Southern District of New York, virtually. So, could you give us a couple of observations about the case? I believe you're in front of Judge Lane, and it was all done by video, or not video, by audio, right?
By telephone, by good old-fashioned telephone. No, so this was one of the first cases, and I think the first major case filed in the Southern District of New York that was entirely telephonic so far. So we had a first-day hearing yesterday in a case with all the normal elements of a real Chapter 11. By real Chapter 11, I mean not a prepackaged Chapter 11 that is, more just a private equity fix of a balance sheet. But this client, LSC Communications, is 19,500 employees, manufacturing operations in 28 states, different business units where people have different views of the values of the different business units. And it's a conventional Chapter 11 in that the exit path is not yet certain, and the company, filed for liquidity collaboratively with its creditors to explore its different options. So a real case, workers, pensions, and the kind of uncertainty that comes with an industrial reorganization. So in the first day hearing, it happened entirely by telephone, but it went very, very well. I have to say, Jim, I was worried before it, but very pleased, both with the way the judge and the court organized all the various conversations. I think the parties all took the situation very seriously in that we were able to resolve before the hearing, all of the various disputes. And when we had a particularly difficult dispute, I think the professionals realized that none of them wanted to be the one to tell the judge that they, for this first telephonic hearing for a major case, that they were the one who was requiring an evidentiary hearing or something else the judge wasn't prepared to do. So the courts are open for business, and that was a real worry. When you think about what makes Chapter 11 as a tool so difficult in these circumstances, there was a short checklist that we went through. We've been going through with a number of clients. And at the top of that checklist was, are the courts available in a meaningful way? And I think at least that answer is yes. The rest of the checklist, can you do a business plan in the COVID environment? Can you get exit financing? Can you get DIP financing? Those all continue to be very difficult challenges.
Yeah, I've seen that as well. We had a confirmation hearing in Delaware by telephone 2 weeks ago, 6 hours long, with witnesses. So I would say the courts are open for business, for good or for bad. Let's cross the pond for a moment and talk to Chris Howard, who's in our London office and is the head of our restructuring practice in Europe. So Chris, there's been obviously a lot going on in Europe. What are the key elements of government support that you've seen out of Europe in connection with the COVID crisis?
Jim, it's very close to what's been going on in the States. We've had rate cuts by central banks. We've had fiscal support in the form of tax cuts and deferrals. and we've had a number of large lending schemes. The problem with the large lending schemes is that they tend to be state-based. It's not there's not a uniform scheme. Lots of countries have adopted their own, and so we've got a patchwork quilt of every European country having its own lending scheme. And the opportunity there is that you can access most of those if you have, the right number of employees, or you can access those programs. There's no caps or limits, and you can take whatever you can from wherever you can. And so a lot of multinationals, a lot of global businesses have been doing that, and we've been assisting quite a lot of very large companies in terms of accessing schemes both in the US and overseas where they've got large subsidiaries. So that's been an interesting thing of taking whatever you can from wherever you can. The other thing that we've started to see a little bit is sort of more innovative schemes. We've got a lot of consumer businesses, airlines and retailers, car hire businesses that have got a lot of credit card deposits and can't deliver. And we've started to see governments think quite innovatively about whether those companies could be saved by being able to issue mandatory or optional voucher schemes, which is not something that was necessarily available under European consumer protection law until governments and the EU have started to think about that. So that's another aspect of, if you like, multiple actions and support that governments have introduced. Some of the schemes have been devised for specific corporates, which can be slightly problematic. We're working on, this is a public case, we've been working on the restructuring of Norwegian Air Services. And what we've seen there is that the government have been prepared to help, but they want an equitization of quite a bit of the debt before they'll put their hands in the pocket and give 3 billion Norwegian NOK krona to that business. And that's creating some restructuring obstacles because we kind of have to do an equitization before we can access the funding. We've seen some issues around state aid rules, and Juan Rodriguez in London and Michael Rosenthal, our partner in Brussels, have been looking at that. The EU Commission has been pretty good in terms of fast-tracking some of those schemes, and they've got a temporary framework for getting those schemes approved quickly. The lending schemes have been interesting. A lot of the government support in terms of debt will constitute financial indebtedness under most European loan docs. And so we've seen a lot of our clients position the loan tactically in the group. They've tried to position this in holdcos outside the recourse group so that we don't bite on restrictive covenants. We've seen creative uses of baskets, and we've seen corporates resort to getting permissions and waivers in order to get government support in where there was a restriction on external debt. And we've seen a lot of lenders being supportive because they've seen government as a liquidity support to preserve their economic interest in a lot of businesses. But the most interesting thing as an insolvency lawyer that we've seen has been quite a lot of insolvency reform. Andy talked very eloquently about, the duties in Delaware under Delaware law. It's interesting in Europe. We tend to have a more restrictive regime for directors. We see directors in the UK, for example, see their directors' duties transition at the point of insolvency to creditors. And there is a sort of Damocles hanging over directors for wrongful trading in the UK, where the point of insolvency is reached, they should be filing, and their optionality diminishes significantly. So we've seen some reform around that in the UK, where the wrongful trading regime has been suspended, which gives directors more options and the ability to trade on and perhaps look at the corporate interest as a whole rather than the lender interests more narrowly. In Germany, we've seen quite a bit of legislative change. Germany is a very restrictive regime in terms of compelling directors to file. And we've seen 3 big changes in Germany. German companies tend to have to file when they're over indebted. That's not very helpful because if you don't file when you've reached the point that you can't meet your liabilities as they accrue, and you don't file with it as soon as possible or within 21 days, that doesn't just attract civil liability for the directors, it also attracts criminal liability. And the German government have suspended that in order to support German companies going through restructurings. And that's been an important step. Lenders have been liable for lending to German companies where they are insolvent. And that has led in the past to German banks and to creditors of German companies seeking restructuring opinions to show that the new money has got a purpose and that the company may come through it. And those sort of restrictions on lending have been dispensed with temporarily. And in the past, shareholder loans in Germany have been automatically equitably subordinated, which has not really incentivized shareholders to make loans. And they have currently been suspended as well. And those are the steps that we've seen in Europe, Jim, that have been interesting, and they've been varied, and they are slightly different across the patchwork of European countries and the members of the EU.
Do you see going forward opportunities for investors as the European governments who are getting involved now are looking to exit those situations?
Yeah, we've seen investors look very carefully at the terms of government support. And we've seen corporates really sort of think about, the programs. And all of the programs have varied, as I said, depending on the size of the program. This is on 25 of the slide 25. We've seen the size of the program could be varied. We've seen guarantee entities and government entities vary. We've looked at the beneficiaries that are different. Sometimes it's protectionist in the UK that you can only make one of the loans available to a company that makes a material contribution to the home state. We've seen turnover tests that are different. We've seen only short-term or long-term maturities on some of these facilities. And we've seen, as I said, in Norway, different priorities. So what that has led the investor community to do is to try and penetrate those schemes and find corporates that can't access them or indeed look at companies that can't get the consents. And we've seen a lot of, we've been working, Chris Beattie, myself and Presley, we've been working on a lot of rescue financings that have come into the market where they've tried to identify those in need who can't access the schemes. And so I think we're going to see this in phases. The first phase has certainly been that community watching and buying debt in the secondary market. We've seen that quite a lot, and we've seen secondary prices in Europe drop significantly. And we've seen some of the smart investors buy debt at pretty heavily discounted prices for really good companies that might be non-investment grade in particular, and indeed investment grade. We've seen some of the hawks circling. And they have made some decent, I think, acquisitions of debt given loan prices. And that was phase one. Phase two is rescue finance. So we identify, and we've seen a lot of our clients identify very quickly companies that are probably going to survive this. There's a judgment call on business plan, on duration of the crisis. But we've seen some of the investors really come forward and put some money behind some decent brands that are temporarily impaired. And that's been stage two, rescue finance. And where we've really started to see interest now, as Neil and Ari said, is there is a little bit of a view that, the markets are easing up, equity markets are improving. We've seen a lot more focus on what happens probably during the next phase of relief, and maybe even the longer term when governments want to take their capital out of these companies. And a lot of funds have been in touch with us about that. We've seen, a 30 billion US distress fund. They called us yesterday. They wanted a call with us. They're a client. They said, look, we've got a ton of dry powder. We've seen some great bargains. We bought in the secondary. We're a first mover. We have got our own views on timing of the recovery, the recurrence and resurgence of markets, and the return to normality. And we'd very much, be very interested in seeing what's out there, what you guys are seeing. And they can see that governments, particularly in Europe, that are already crippled with debt, are going to have to delever their own balance sheets. They're going to be under pressure from the EU and from the European Central Bank. You've got a lot of conversions on the euro that's going to put pressures on governments, particularly maybe Italy. And we're seeing governments that will probably want to deleverage over time, which is going to create investor opportunities as governments exit some of these support programs. The issues for this are going to be politics, which is going to drive it. In the UK, for example, nationalisation is not a great word. It's not politically sort of what this government is about. From a political perspective, timing of the recovery is obviously the unknown. Liquidity is tight, particularly amongst the clearing banks and the large banks in Europe. They've retreated somewhat, even though they've been encouraged to lend through the government guarantee schemes. And what is the scale and bandwidth of companies to recover and how quickly? And then on the government side, as the government exits some of these loans and some of these support programs, the governments, how are they going to behave? Are they going to behave like commercial rational animals? Are they going to take on advisors? What is the procurement process for government to do that? And how slow and fast can government move? And what's their scale for dealing with the exits and the bandwidth? And we tried to set out on 26 what some of the, on slide 26, what some of these options are. Debt forgiveness is again not a thesis that we think is particularly likely. Politically, it's going to be unacceptable, particularly if these companies recover and the government have forgiven debt. The experience we saw in the financial crisis has shown that this is unlikely, of course. And the UK government in particular has behaved commercially, professionally and assertively in many of the situations that we've seen pre-crisis where they have supported companies, and particularly on the exit from the financial crisis, we've seen them behave that way, the way they in effect nationalised banks and have come back to the market and started to release some of that equity. And the government has got some very decent departments in the UK, just as the German government has with KfW, their investment bank. And we've seen a lot of thinking go into the way exits might take place within government. As I said, nationalisation is not really it's a bit of a dirty word in the UK, but there may be sectors where this is an imperative. Transport, for example, rail, buses, airlines and infrastructure. You can see the government maybe being forced to take some of those businesses in the interim, which have suffered so badly during the crisis, onto their own balance sheet. And then there's going to be issues of valuation and legal challenge around that, particularly if some of those businesses recover. But we see this as an option really that will preserve continuity and avoid insolvency of important assets. Reprioritization may take place as part of the recovery and the exit, where governments think about maybe replacing their loan that is kind of stuck and it's kind of stodgy within a capital structure, and maybe moving it around, subordinating it contractually behind other debt or moving it to a holdco. That might be a possibility, and funds are thinking about how that might be done and whether their injection of new capital to get government support terminated could be done through funds coming in and replacing government debt and allowing government to maybe moving up the organogram or being contractually subordinated. This again may depend on the sector, and it depends on how fast these companies need to grow and attract new capital. Equitization is a possibility. We saw that in the financial crisis, of course. Again, it depends on the sector. There may be state aid clearances for this, which is interesting. And then what are the conversion economics going to be? Debt sales, yeah, government may sell debt. Government may be, a large holder of a lot of corporate credit, ultimately through the guarantees, and they may want to sell that maybe at a discount. They may want to refinance that through some of the British or German sort of investment banks. British business banks are kind of government investment bank. KfW in Germany, they may be happy to sort of see government debt that's been put into specific businesses like airlines go into the government investment banks. That might be a favourite option because it doesn't allow or doesn't need governments to take a mark. There may be valuations if they're selling that in the secondary. And then obviously the last option is, some of these businesses that recover, there may be a round of sales by government that initiate those sales through the debt that they put in. There may be some IPOs, and there's going to be quite an interesting market, I think, as we come out of this crisis and we see governments want to retreat and we want to see new investors come in. So that's a kind of snapshot, I think, of Europe and some of the opportunities that we might see.
Well, thanks very much, Chris, and thanks everyone, Chris, Inosi, Andy, Ari, Neil. Thank you all. I'd like to thank everyone who tuned in today, if tuning in is the right thing you say for Zoom. And we'd like to invite you to join our partners tomorrow at 9 a.m. for a review of the global capital market and the impact of COVID-19. We'd also like to invite you to keep up to date by going to solcrom.com, where we have multiple daily updates on issues relating to COVID-19, CARES Act, and everything else that we're all dealing with on a daily basis. So thank you very much for joining us. Please, everyone, stay safe and healthy.